Hey everyone, welcome back for another YouTube video. All in Crypto here, and this is going to be your daily cryptocurrency market update. We're going to do quite a bit in this video. We're going to start things off by looking at the more sort of immediate timeframes for Bitcoin. Bitcoin is a very good representative of the overall cryptocurrency market and where it's at. We'd expressed a bit more of a relief rally, a Santa rally, taking place since we had the short squeeze at 15,600, which we called. But it's a very, very challenging environment to be day trading right now. I have to be 100% honest about that. You know, this week I've not had much success at all. And I think that's because, well, first of all, it's you know, has a lot to do with how I'm trading. But sort of secondary to that, remember, guys, you are the ultimate deciders of your own destiny. When it comes to trading, you are the only variable that you can control, and you need to see that as the advantage that it is. You can't control the market, but you can control your actions towards it, as a little side note. But for example, yesterday, we will get into the more immediate time frames. I'll just highlight the video before we actually get into it and talk about, you know, what really moved yesterday's market, which was, of course, the US producer price increase. So this is an inflationary... This is a tool used to sort of track inflation. This came out a lot hotter than expected. This caused the dollar to spike, caused assets to drop. So this had a lot to do with yesterday's price action. This is interesting going into a CPI print on Tuesday. So we'll go through all this, and then we're going to look at some of Blackrock's comments, because we've said and we've continued, despite being short-term sort of bullish, short-term being a matter of weeks, which may have already played out, we've continued to reiterate our stance that, look, we are heading into a very tough time. We're already in one, and it's going to get a lot worse in terms of liquidity. You know, markets are liquidity junkies. This is a consistent theme that we've maintained on this channel for months and months now, that, you know, from an investment point of view, it's all about liquidity. But we are heading into a recession, and BlackRock are calling for a recession like no other. So we will get into a lot of this. I want to also bring up Apple, because if you look at the likes of Apple or Microsoft or some of these other companies, they haven't seen the worst of what's coming. I mean, these are only 22% off their highs, and that was after an absolute print-a-thon and all this money. I think there's a lot lower to come down, and Apple is a huge part of the S&P. In fact, Apple alone is worth 180 companies within the S&P. So let's just start on the short-term time horizon. So we still think this is going down. We're not investing here. We've maintained that bias. And from an investment point of view, we've been very spot on. From a day-to-day basis, you know, we've been relatively spot on, but it's been very hard to call sort of within that day what way the market's going to move, because there's so much going on. So we know how we've got to where we've got to. This, of course, was the FTX spill, and we have been in this range thus far. This was something that we shorted, this grind line, and we essentially spilt. We're now, this was, of course... really, we were calling for a short squeeze to take place here, which is what started this rally. Here, for example, you had the BlockFi news, and there was also economic data. And, of course, here, yesterday, for example, we had the CPI print. So we actually did look for some longs here, but, of course, got stopped here. This downward trajectory that we saw for Bitcoin in terms of intraday was caused by some of the inflation figures that we had for the United States. So the US producer price increase, near-term inflation expectations ease. So they're looking at still a bit of an easing in inflation, but the core producer price that we had actually came out significantly hotter than what the forecasts were expecting. This is sort of highlighting more of a persistently high inflation. This, of course, affected the dollar. So we can actually probably just keep the Bitcoin chart on and drop the dollar in there. You can see what happened here. So this was round about when the news hit. You can see the dollar got a bit of a bid. Of course, people would have been pricing and looking forward at interest rate hikes and how this inflation figure may affect them. Caused Bitcoin to sell off. And this is the hard part about day trading this market right now, is that there is a lot of other things you've got to pay attention to. So there may be a setup there. You may have a good risk to reward trade going, and then you'll get economic data that will essentially cause the market to move or act in a certain way. The problem with markets right now, and it's not really a problem because you can very much use it to your advantage. Part of my trading is looking and doing cross-market analysis and looking at other markets to kind of give me a feel of what the bias of the day may be. You know, if I know that the S&P is doing well, gold's doing well, the dollar's doing poorly, you know, we see some good movement in the Asian markets moving into London session, and then of course the United States session or Washington session. Then I know that the odds are more in my favor of a long bias for that day. And if there's a setup there, it all ties in. But you can see that this was literally caused, and you have a lot of bots basically that will trade other markets. They'll understand the correlation here. The fact that we're coming up and bumping our head here, guys, is not particularly brilliant. You know, this is obviously support that's now confirmed as resistance and may look for that downside. But there's a kind of correlation with markets, and bots will trade this. It's why altcoins move with Bitcoin. It's why Bitcoin moves with the macro, because there's a lot of cross trading going on. So this is why we spilt yesterday, and we've kind of said really since here, we've been looking and we've been chopping this up in terms of ranges. You know, short squeeze, first level of support. Actually come and revisit it at support later on. Here we were looking to long. We got the BlockFi news. Of course, we got out. And then we get the continuation. So there's external things moving this market. Coming up, this was beautiful support. Again, this is support and resistance lines work, guys, because markets will often seek them out. And TA is often a very self-fulfilling prophecy. This was resistance, support. You're holding it. You had this spill to the downside. Very similar thing of what took place here. Looked for the longs here. Into this, looked for continuation, and then you got stopped short. And I think there's a lack of bid in markets going into the CPI print. So right now, you know, there is still the possibility that you come for these higher levels. And I think that this is going to all depend on the CPI print that we get, which if we look at core producer price index, you know, it may be telling that potentially if we have a forecast for November, looking at 7.6, so a 0.1% decrease in inflation, which may show that it's coming down, but still, in my opinion, negative because it's not coming down in the sort of degree that they're expecting it to. And we know potentially why this is. Then maybe markets act positively. But if it comes out higher, like the core CPI having that, or producer price having that sort of negative effect on Bitcoin here, you could be looking at that next leg low. The dollar, of course, it will get a bid. And just based on sort of the overall macro, you know, we think that if interest rates stay high and continue to go up, it's going to put more strain on markets across the board. That's not even factoring in all the risk factor we spoke about, the yield curve, so on and so forth. So that's really our short term is just looking at this and looking to see which way we go. So do we try and push up here? You know, if you wanted to chop this down a little bit more, you'd look for areas like here. You can see the reactions here. You know, you're going to want to look for something like this coming up and then holding, and then you just expect continuation on the short term. Problem is, again, going into CPI, I think there's going to be a lack of bid because people won't want to position into that because it's hard to do so. You often get these big volatile moves where the price looks like a heart monitor. You know, you'll stay flat on the day and then you do something like this and then continue the trend. But during this time, both stops are getting hit. So it's going to be an interesting week. For me, personally, I've almost been forcing, I think, the trading over the past week in this kind of a market. You know, we've been right on the upside, but for me, it's always about, I'm very good at sort of predicting the market. Positioning into a market, though, is a whole different kettle of fish. I know some people who are amazing at predicting things, but they're bad traders. And it's because it's a whole different ball game. But that's for another video. So this is really what we're looking for. Potential continuation upside. It's going to depend on the CPI print. This is not out of the realms of possibility. Ultimately, when we look at the broader picture, we do think that this market is confirmed to be going down. And we think that that has to do with everything. Now, moving on to BlackRock's comments. BlackRock says get ready for a recession, unlike any other. And what worked in the past won't work now. So they came out and did a sort of new report. Some of the takeaways is the global economy has entered a period of elevated volatility and previous investing approaches won't work anymore, BlackRock said. Again, we spoke about the fact that March 2020 was completely a rear-ending event in terms of it ended the 40-year bond market. You know, that market is very associated with the monetary system. In fact, it's the bedrock of it in many respects. And that changes like that are not to be taken lightly. And they kind of, you know, the ripples of it have not been felt yet. A recession is imminent, but central banks won't be able to support markets this time by loosening policy, according to the money managers, because they essentially can't. Recession is foretold as central banks race to try and tame inflation. It's the opposite of past recessions, Blackrock strategist said. And then they go on to say a number of other things. But we've been calling for this now really since the start of the year. It's coming. It's been a long year. Markets have sort of bled out with their own little events. But I think we're still yet to find, talking about Apple, this 2008 moment. We're looking for somebody to blame basically at this point, because of course it can't be the incompetence of the central banks, even though they're totally to blame. We're looking for this price action. In my opinion, we've still got this to come broadly for markets, which is why we've tried to keep everybody out. Now, that is not financial advice, just my own opinion, but I have a vested interest in keeping people on the right side of this. And hopefully we've done that. We're never usually the first, but we do certainly have a good handle on things moving forward. You know, I mean, look at this. This was in 2013. You know, this sort of crash, I think we're yet to see. We're only 22% down thus far. So there could be the argument that, okay, something like Apple with derivatives is a cash cow, but it's only this much down and it has a lot lower to go. And the argument's always been for us, and we did a whole analysis on the S&P looking at this. So please try and find that video. This is now on its next leg lower. We got a bid exactly where we said we would, looking at the daily, you know, the 30 MA. We said, look, you're going to get a bid here, but it's going to get harshly rejected. Of course, this ended in the red based on the core CPI. This is very much all still to come, ladies and gentlemen, and you need to be prepared. And this is financial risk, let alone geopolitical and everything else going on. You want to be out of markets, in my opinion, to not sort of deteriorate with the situation. So we maintain a dollar long bias in terms of we are all in dollars, we are all in fiat, waiting to accumulate. There are talks about banks and counterparty risk and you know what's going on over in the Asian region and other regions where people are talking now about forming a coalition, BRICS, moving on to maybe a different global reserve currency that we do need to factor in. But for now, that's not at the forefront. You know, we're really trying to navigate this market, and it's always been the case for us that, look, the dollar's likely to reassert. It's probably going to be on an event that's going to cause it to reassert, i.e. people run to the lifeboat. This is going to drive everything down, and we're just waiting for this yield curve to play out. So that's all I've got for you in this video, guys. If you enjoyed this content, like us, I'd appreciate it as a comment. A bit of a in-depth one, I guess, in certain areas. So the week ahead, you've got to look out for the CPI. Look out for this play on Bitcoin. I mean, it's very much, you know, I know this doesn't give people much satisfaction in saying it could go up or down, but it's going to depend on economic data, in my opinion, as this market is now very much aligned and driven with it, which makes it hard or frustrating for me as a trader who will look for price action and setups to navigate, because I have to, you know, account for this bigger market because of the time frames that I play on, typically the 1 hourly and 4 hourly. You know, you almost have to be more of a macro or more of a bigger time scale person so that you can account for this volatility that you get on these economic events, which just means adjusting as a trader, I guess, which is what we are good at. All I've got for you in this video, guys. You enjoyed the content, like, so appreciate it. So as a comment, and I look forward to seeing each and every one of you in the next YouTube video. Have a wonderful Saturday, guys. See you in the next one.